how much does profitability actually matter when it comes to, valuation, particularly when you're a startup and you're trying to, you're focused on growth, more than anything. So if you're focused on growth, should you care about profitability? Does it actually matter in terms of your startup's valuation? The answer is an interesting one. It's not so much your current profitability that matters, it's your potential future profitability that matters, because all companies at the end of the day they're valued based on something known as DCF, or discounted cash flow. And I won't bore you with the whole finance lecture, but this is the core. Every acquirer wants to eventually make money through purchasing your company, or for that matter, if a company gets large enough and they actually IPO. That's eventually what folks are looking for. And we can see this. We can see this in, think about the newer sort of tech mega caps, companies like Meta or Facebook. So Meta is a really good example of this. There was a time not many years ago when Meta produced essentially zero profits. Actually, they were still losing money. And lately, if we look at in the last several years, they are a cash machine. They are printing money off of their advertising business that's tied to Facebook and Instagram and the other properties. And so really, when folks were valuing Meta or Facebook, as it was known then, when they were valuing that highly 10 years ago, that was based on future expectations of profits. And so that's where Meta, sort of went up into the moon, because it actually proved it. And, if you look at Amazon, same thing. Amazon was actually profitable in a sense many, many years ago. But what Amazon did was they kept reinvesting all that cash flow into the business. And then only in more recent years did they start to show that, like, okay, now as we've taken over, or sort of the number one, from an e-commerce perspective, number one, from a cloud hosting perspective, cloud infrastructure perspective, number one, when all of that had come together, then they start to release some of those profits and to show that to Wall Street. And so, the same story, there were many, many years of losses and investments, but eventually the earnings for both of these, have started to skyrocket. You can see that. And by the way, it's also true for Google, any of these companies. Apple's been doing it for a longer period of time because, a more mature company. But with any of them, we see that they really all along have been valued on what was the future going to be? How much profit were they going to bring to the table? Okay, and so if that's the case, then what does that mean? What does that mean for your startup in terms of how you should think about that? So how you should think about that is in terms of what we'll call EBITDA percentage or EBITDA margin. So what can you get to, and EBITDA is sort of the fancy word that they use, and I'll simplify it in a moment here. So EBITDA margin. So basically, what's your profit margin? That's what this really means. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So most companies, most startups, don't have, in any meaningful sense, they don't have most of these letters. And so really what you're looking at is, what are your earnings, what are your profits before taxes? That's sort of the ball game right there. And what is that as a percentage of your total revenue? And so if there's a future world in which your profit margins can be, say, 50%, then that is going to be a company that is much more valuable than a company whose future value or future margins are 5%. What I mean is in terms of a revenue multiple. So this kind of company, which all SaaS companies, they have the opportunity to get there. In reality, like even when we see in public markets, most of them don't get quite this high, but it's possible for a software company to get to these margins. And that's where you get the 10x kind of plus rev multiple, right? That's where that comes from. But on the other end of the extreme, like the other extreme down around 5% or potentially even lower, this is actually where big retailers are. And so you see this with, even in e-commerce, if we stay in tech, in the e-commerce space, you will see that profit margins, as a percentage of revenue are quite small. And so this kind of story leads to a 1x, sometimes below 1x rev multiple, because you're selling product and most of that money doesn't go to you. You're an e-commerce store. Most of that money actually goes to purchasing the products, whether you're importing them, whether you're getting them from other, local manufacturers, however you're getting those products, most of the money is going back out the door. So most of your revenue is not your own money, and therefore your margins are that much lower, which you can see the linearity in this, and I'm using, rough numbers, but it is essentially like that. As this percentage drops, you're going to see your rev multiples drop as well. And so as you're building a company and as you're preparing to get toward a sale, say you are a SaaS company, but say your expenses, and all of that is such that you can't really show a story toward profitability at all, well, then you run the risk that you're going to get lumped into somewhere further down the range. You may get penalized for that. If you're growing fast enough, growth conquers all problems, and so you can avoid having the conversation. But if you're not growing north of 100% a year, then inevitably it'll come back to, okay, but what are the unit economics? Can this company be profitable from the marginal sale? Like if they have 1,000 customers, the 1,001st customer, are they making money on that one? Or are they going to be 10,000 customers before they make money? And so those are the kinds of questions a buyer will ask. And if they conclude that, well, there's no money in it, even when you get out past that 10,000th customer, Adam Neumann stories aside, and folks who can tell a good tale to the market, and sort of con their way to success, leaving that aside, if you can't make money when you get to that 10,000th or, that nth customer, well then there's probably no reason to buy your company. And so that's really going to impact your, whatever multiple, if there is any, for a sale. And that's really where profitability comes back in. So profit margins do matter. Future profit margins are what matter. But buyers will look to get an understanding of how you're going to get there. And are you eventually going to end up here, which dictates the higher multiple, or are you eventually going to end up down here or below, which dictates somewhere between a very low multiple or no purchase at all?